If you put an equal amount of money in these 6 stocks, your dividend yield would average over 6.25%, and the dividend would grow every year, and you would have plenty of upside to fight inflation in the portfolio. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. Doing a video today, I'm going to try to cover a lot of different bases here. Number one is I want to talk about a method of investing for income and to fight inflation in this inflationary environment we're in, where you can beat inflation through total return, but also have a high enough dividend income yield that you can possibly live off it, if you will. And what I'm really going to do is talk about how to do that. So I'm going to call this 6 for 6. I'm going to cover 6 stocks that will give you an average yield, if you put equal amounts of money in each of them, over 6%. And again, that dividend growing. A couple of these stocks have been requested. So that's the other base I'm going to try to cover. I'm going to try to show you some of the stocks that you've all expressed interest in. And what I'm really doing here also, and I want to make sure that I really express this clearly, is that you don't always invest to make the most money. Sometimes you invest to take the least risk. You don't always invest for minimum income. You might want to get maximum income and have dividend income growth. And there's a lot of different ways that you can build a common stock portfolio. So I'm going to do kind of a mini version here of a portfolio of 6 stocks that combined would give you a dividend yield of over 6% and show you how I blend these stocks together to accomplish that goal. I also am looking for good quality here. So I'm going to go through each of these stocks and I'm going to do what I call an analyze out loud video. So let's go ahead and get into the portfolio. And let's start by picking the first one, British American Tobacco, and taking a look at it historically on the fast graph. Now, one thing I want to mention is this is an ADR and I'm reporting on this as in US dollars. Okay. The reason I mention it is because you'll see some inconsistencies in the dividend that are really more of a function of currency exchange rates than the actual operating results of the company. But this is technically a stock that's out of the country, United Kingdom. And, it's obviously listed in the currency of the United Kingdom rather than the United States. But what I want you to see here, this is the tobacco company, obviously. Its current dividend yield as of today with the stock price dropping a little bit, its current dividend yield is about 7.08%. It closed yesterday with a dividend yield of 7.05%. So let's start with a company that has a dividend yield above 6%, actually above 7%. And, that becomes important later. Now, what I'm going to do here, I'm going to go through a fast fundamental analysis, I like to call it, utilizing fast graphs. And what I'm going to do is with the fast graph itself, that's the basic fast graph, I'm going to look at 4 or 5 very important metrics, if you will. I'm going to look at earnings growth and or cash flow growth. I want to look at valuation. I want to make sure the stock is trading at a discount to what its intrinsic value would be. I'm looking for dividend growth if they pay a dividend. And again, this one actually has it, except this is in US dollars rather than, British currency. I'm looking for reasonable return expectations. I'll get into that when I get into the forecasting graphs. I'm looking for investment grade stocks, BBB minus or better. I'd throw one in here that isn't BBB minus, has no credit rating. It's a relatively new stock, but it is high yield. And in the spirit of diversification, I'm going to mix it in here with the other 5 companies. I want to see free cash flow covering the dividend. This would be things that I would look for in the fundamental analysis, where I'm looking at the financials or what we call the fund graphs, or not what we're also going to soon be launching, which is called our fiscal fitness graphs. And I'm looking for cash flow from operations higher than income, sales growth trend over at least the last 3 to 5 years. I want to see growth, net income growth likewise over the last 3 to 5 years. I want to see a debt to equity ratio that's aligned with industry norms. 1-to-1 would be ideal. $1 of debt for every dollar of equity. Gross margin versus net margin. I want to see industry norms. I want to look at asset turnover. This is all for fiscal fitness. I'm going to look at return on assets, returns on equity, and then I'm going to look at another margin besides gross, and then I'm going to look at operating margin. So I'm going to run all of these companies through that kind of model, if you will. So let's start out by British American Tobacco. You can see the company has historically grown earnings at 8%, going all the way back to fiscal year beginning in 2002. It's been a little bit lumpy, but really pretty good consistent earnings growth over this time frame, and a pretty good record of dividend growth with a relatively high payout ratio, and again, yielding over 7% currently. The stock has been trading below its normal intrinsic value, which I would call 15 times earnings. Right now, the stock's been trading at, 10, 11 times earnings. You can currently buy it at a blended PE of 8.94, just under 9 times earnings. I consider that extremely inexpensive. And so for whatever risk there is in tobacco stocks, I think it's already baked in. I'm going to go to our forecasting calculator here now and cover what I called reasonable return expectations. If this stock were to return to a 15 PE ratio, and I want to emphasize, prior to 2018, the stock traded at 15 times earnings most of the time and even higher. And even when it got low like it is now, it always moved back into that 15 PE or higher. So I don't consider this to be an outrageous expectation. If that were to occur, rate of return annualized would be enormous for this first fiscal year, be averaging over 68% over the next fiscal year. And by the way, they do have a calendar fiscal year. And if you went out to fiscal year end 2024, we'd be looking at 41% potential rates of return. If I use the normal multiple for the last 5 years, I want to emphasize that, the 5-year normal multiple, which again has been somewhere between 10 and 11, as I mentioned, you still have rates of return that would, exceed 24% per annum over the next 2 or 3 years. And that's getting a 7% dividend yield while you're waiting. So the stock looks very attractive. Now I want to go into the financials here. Well, you don't have this available, those of you who are subscribers. We're working on this in conjunction with our health check. We're trying to come up with a methodology to make it very easy for you to check the fiscal fitness or the health of the companies that you're looking at by running through a group of metrics. We're using, basically 12 metrics right now, or 10 or 12 that we're going to be covering. So I'm going to go with free cash flow to the dividend. And here we're using free cash flow to equity per share. And I want to see that generally higher than the dividend. Now, this company failed that in 2017, but otherwise their free cash flow to equity has been higher than their dividend. So that is a good sign. I want to see operating cash flow growth, and I want to see this for at least the last 3 to 5 years. And here they've grown their operating cash flow by over 11%. I think that's very positive. Share buybacks are important. This company has been issuing shares through 2021. I actually consider that a negative because, again, if I go back into the company's historical graph and I look at what they were doing over the last 4 or 5 years, they've been issuing stock when their stock is real cheap. Perhaps they needed the money, but I actually would consider that a negative here. Operating cash flow greater than net income. That's again to see if the dividend is safe. Now this, where their net income ballooned so high in fiscal 2017, that was as a result, if you go through their financials, of buying Reynolds American. And by the way, with the new version of FastGraph soon to be launched, you'll be able to go through their financials and you'll be able to focus on, what happened in any one of the years. You can go through their whole financial statement. That's another feature that FastGraph is going to be giving you here in the future. But generally speaking, excluding that one anomaly here, their operating cash flow has been higher than their net income. I consider that very positive to the dividend, if you will. Now, looking at sales revenue, the company has grown their sales by almost 12% a year. That's a very positive trend also. If I'm going down to net income, here, once again, I want to see net income growth. It's been averaging about 8% if you go from here to here. They had that one anomalous year in 2017 when they bought Reynolds American, so I think you ignore that. But it's been growing their net income at a very good rate, if you will. The next thing I'm going to look in debt to equity. Now, debt to equity is a very interesting ratio. What I want to see with debt to equity is I want to see a company that is fiscally healthy. So, what this is saying is this company has about 66 or 53 cents worth of debt for every dollar's worth of equity they have. And I consider that very positive. The company's fiscally healthy there. As far as margins, we're going to look at three basic margins here, wrapped up in one. I'm going to look at gross margin, and then this line compares it to the industry norm. So this company is right in line with its industry, even slightly a little bit more positive, if you will. Their operating margin is also very strong. Their gross margin is extremely strong, and their net margin is really good at over 25%. And again, you got to exclude the 2017 number. So bottom line is, the company looks really good. Asset turnover could be better. They're a little below industry standard, and I'm only looking at the last 5 years. I can look at this company, long-term historically, but lately they've been, kind of falling off the wagon a little bit. But I still think it's reasonably healthy. They're turning over their assets well enough. That's, for this kind of company, that's not that important. Return on assets have been, 7 or 8%. I'd like to see this a little higher, 10% more recently. And return on equity has also been, inconsistent with industry norms at about 10.5% here last year. But, I'd like to see 15% or better. But all in all, I would call this one a very interesting company from a standpoint of really great value, good dividend growth. And if you looked at long-term performance of this company, even discounted, it dramatically outperformed the S&P, and it outperformed the 8% inflation rate that, we're struggling with right now in America. So I think that's also historically important. So that's British American Tobacco. Many of you have asked me to cover this company. So there you go. You got to look at British American Tobacco. And again, it's been inexpensive for the last 4 or 5 years, which could be an inflection, by the way. That's something your research and due diligence would have to take into consideration. This is a very interesting one, and I went ahead and chose it because I wanted you to kind of get an idea of how to use FastGraphs effectively. Now, this company is a cannabis company. It's called an industrial REIT. It actually is a REIT. So what I'm going to do is I'm going to go to FFO and look at it from the standpoint of funds from operations. And, that's what's important with the REIT. And if I look at this long-term chart, okay, it looks like this stock has been massively overvalued this whole time. But I want to point something out to you. The company initially came out as a cannabis company. They actually finance properties for the cannabis industry. And again, with FastGraphs, you can go right into the company's website. This is very important when you're conducting your due diligence. You can see they're the leading provider of real estate capital for the regulated cannabis industry. You can learn a lot about the firm, the businesses they work with, etc. This one does not have a credit rating. It's a little bit speculative, but I want to show you something. This is where the dynamic nature of FastGraphs is so important. I've got a 220% growth the first year, 83, 119, and then 62. So these first several years here have been just amazing. So if I shorten this to 7 years, my growth rate now stops at 44%, and I've got the 83, the 19, the 62. But I want you to notice that the growth rate is slowing down. Now, that's very important when you're analyzing this stock and trying to make a buy decision. So based on its historical growth, the company looks very, very inexpensive here. But if I go into the forecasting calculator, it's expected to grow at around 14.5%, which is very attractive. And the company looks undervalued by a smidgen here, not a lot. But it does give you the opportunity to generate over 20% annualized rate of returns. And once again, we have a dividend yield here of over 7%. I think as of today's price, last time I looked, it was yielding about 7.35 or 6. So what we have is a company that was, and I want to emphasize this, that was historically overvalued, apparently. But as I change time frames, I see that the company was historically overvalued. It has now become fairly valued. But again, I'm using the tool to help me determine what is really going on with growth. And you can see growth has slowed down precipitously, but it's still very, very fast. And it's still going to expected to be very high. So that would be Innovative Industrial Properties, Inc. Now, running it through, the same type of thing I did with British American Tobacco. Free cash flow to dividend kind of fails. It's a brand new company. We're using free cash flow to equity here, which we consider to be a little bit better form of free cash flow. If I went and looked at this company utilizing what I would call the normal, free cash flow for a REIT, it doesn't look quite as bad. The AFFO, adjusted funds from operations, I should say, has been covering the dividend. So I'm going to give that one a pass on that metric, if you will. If I'm looking at operating cash flow growth, it's been very strong, averaging again, over 30% growth. So this is a young company, but they've been growing very fast. Share buybacks have been interesting here because what they've been doing, they've been issuing shares. They went from 162,000 to 2.6 billion shares. So I think that's really important. The company's growing their share count, and they're doing it as the price of the stock has been very high. That's a cheap way to raise money. And you can see the price has corrected dramatically into more realistic, levels here. And if I shorten the time frame, it actually looks like it's become undervalued and only slightly undervalued based on expected growth going forward. So I think that's, real important for you to take into consideration, but use the flexibility of this tool, to help you make these kind of decisions. Operating cash flow higher than net income. We can see that net operating cash flow has been higher than net income, all except for 2017. But that's a real good sign. It's a young company. It's just kind of catching its own. Sales revenue has been very strong. The growth rate has been powerful. So it's a speculative company, but it does have some fiscal fitness to it. Net income growth has been also very strong, and I want to go to where I don't have a negative number, and I get an aberrant number here, but it's been very, very strong. Debt to equity ratio, the company has 20% debt to every dollar's worth of equity. I consider that very attractive for a speculative company. Their gross margins have not been that good. Their operating margins have been better and above industry norms, and their net margins have been pretty much in line with industry norms. So I like that. Asset turnover for a company like this, it looks attractive. It's inconsistent with industry norms. Return on assets is, extremely high at not extremely, but over 15%, which I like to see that. And then their return on equity has also been very high, and it's been over 20%. And again, it's better than industry norms now, but it's been a little below industry norms early, but it's gotten better. So that's Innovative Properties with an over 7% yield. The next stock on the list here we're going to take a look at, we're going to go just down the line. We're going to look at Leggett Platt. And, Leggett Platt is a home furnishings company primarily known for their beds. So I'm going to look at it from a standpoint of adjusted operating earnings. And what I want you to see here, the importance of valuation, as I harp on so many times. If I run this as a 17-year graph, you can see the stock was fairly valued coming into the Great Recession. It actually performed pretty well during the Great Recession, the 2008-2009 recession. A little bit cyclical, but it does have a very strong dividend growth record. As I want you to notice, it's BBB rated. Undervalued right now, in my opinion. If I'm looking at forecasting, even based on with very little growth, I can get 10 to 11% growth. If I look at the normal multiple, my potential rate of return would be much higher, almost double that at 23%. And I want you to notice, this is what you learn from looking at the fast graph. The market likes this company generally and has generally put a premium valuation. That's the blue line on the graph, the normal PE or the market PE, if you will. So now going into Leggett & Platt and running it through fiscal fitness, real quickly, free cash flow to dividend has been very good. It's been higher than the dividend. It did fall short a little bit here recently. Operating cash flow growth has been good. Share buybacks, the company has kept a level amount of share count. Operating cash flow to net income has been above. Again, it's falling down a little bit here this year, but it's still good. It's still okay. Sales and revenue growth have been reasonably strong through this period of time. Net income, has grown at about 9.5% per year. Their debt to equity is, 1.18 as of last year. So that's, basically still, really good. That simply means they have $1.18 worth of debt for every dollar's worth of equity they have. Their margins, if I look at them, I'm going to look at them over the last, 9 or 10 years. Their gross margin has been sub-industry standard, but their operating margin has been pretty much equal to the industry standard, falling below a little bit, and their net margins have been pretty much industry standard. So it is a good quality company. Asset turnover has been, consistent with industry standards. Returns on assets are good at about 7 or 8%, industry standard pretty much across the board. and return on equity has actually been slightly better than industry standards. So, this one looks very good with a dividend yield of actually, as of the time I'm doing this video, it's about 4.9% above the 4.7 you see reported here. Again, these are blending these companies together. I'm mixing 4%ers with 7%ers. I'm trying to average something in the neighborhood of 6% or better so that you've got really adequate income coming off the portfolio, even better than bonds currently offer. And you've got some upside, as I mentioned. Altria has been an 8% grower. It's been very consistent. The dividend, just like British American, they've been undervalued, but the companies are doing a lot of things to, really keep themselves in balance from a standpoint of forecasting. If I go to a normal PE, I've got a very powerful rate of return potential. And if I go to the normal multiple for the last 5 years, which has been below, it's been subpar, if you will. If I look at the historical graph, the normal multiple for the last 5 years, actually I got to do 7 years because I'm including some estimate data here, has been, most of the time it's been somewhere around 10 or 11 or even below 10 or 11. You can buy it today at a blended PE of 9 times earnings. I consider that very, very attractive. And I believe that gives you a really strong potential rate of return with a dividend yield of, 8.8% as of the last time I looked at it before when I was doing this video. So, very attractive offering there. Omnicom is an advertising company, offers about a 4.3% yield as of today. It's undervalued for the first time. Normally, the market likes to put a little premium valuation on. So if I go to forecasting here, I can see that the company gives me, really significant rates of return. If I look at the normal multiple for the last 5 years, which has been lower, I'm still looking at 20% plus rates of return out for the next 2.5 years. And once again, and I'm going to quit doing this now. I'm trying to show you how I do it. But if I go through, most of these metrics here, free dividend to cash flow, operating growth, share buybacks, which are valuation based. The company's been buying back a little, some of their shares when the stock's been cheap. Operating cash flow greater than net income passes the test. They've got good sales growth, good net income production. Debt to equity ratio is reasonable, but maybe a little high. Their margins have been within, their operating margin and net margin have been better or within industry standards. Their growth margin a little less. Asset turnover has been consistent with the industry. Return on assets has been slightly better than the industry average, and the return on equity has been much better than the industry average. So Omnicom looks very attractive to me. The next stock we're going to look at here on the list is VFC Corporation. VFC Corporation is one of those ones that I've been asked about. Now, there's a couple of things I want to point out about this particular company that I think that are important. I'll make sure I've covered all the stocks I have. This will be my last one. If you look at this stock, I want you to notice their fiscal year used to be December. Somewhere in 2016, they actually decided to move to a March fiscal year. A lot of clothing companies like to have a fiscal year where they close out the books the last quarter, Christmas season and so on. So there's a period of time here where they reformatted their fiscal year. So they went from a December to a March fiscal year end, and that, makes the graph a little bit funny, but otherwise the company has a really good long-term record. It's A- rated. If I put VF through, the paces here, other than the 1 year in March of 318 when they made that transition, the company has had free cash flow, higher than the dividends. Operating cash flow growth has been good, except again for that one transitional year. Share buybacks, they've been buying back a little stock as the stock has been inexpensive here. Operating cash flow to net income has been generally good again, except for the one transitional year here, which I think you ignore that. Sales revenue has been good. Net income has, faltered a little bit, but it's generally been good. Debt to equity ratio, a little high here at 2.27. Their operating margins are, a little substandard, but decent. Asset turnover, they've been better than the industry average. Return on assets, they've been generally equal to or better. And return on equity, they've been equal to or better. So this is still in development. You don't have this available if you're a FastGraph subscriber. But anyway, the bottom line is these are 6 stocks: British American Tobacco, Innovative Industrial Properties, a cannabis REIT that finances property, Leggett Platt, Altria, Omnicom, and VF Corporation. This would give you good diversification. It would also give you a dividend yield of 6.25% plus, and a dividend that's grown every year, and the ability to generate some very good capital appreciation in some very high quality stocks. This is the way you can blend stocks with lower dividend yields with stocks with higher dividend yields to kind of create some income. And of course, valuation is such a critical part of this. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed my 6 for 6 here. 6 dividend growth stocks that can give you an average of 6% yield. You can blend those together. They build a nice core of a portfolio. You can expand this out. There's plenty other stocks, several REITs. Some of the MLPs would be, very high yielding. And there's a lot of good quality stocks that also, provide that. One of the things I routinely do, and let's go back to FastGraphs for a moment, I keep track of portfolios. I keep track of companies that are coming into fair valuation. As you can see, I have a portfolio here. I call it my core income buys with 84 stocks in it. And the reality is, that doesn't mean I'm going to buy all these stocks, but it gives me a group of stocks that I can look at. Anyway, this has been Chuck Carnevale, as I said, aka Mr. Valuation. Hope you enjoyed this video. If you did, ring the bell, give me a like. Remember to do your own research and due diligence on all these stocks. I think all of them are traded at low enough values that they're worthy of spending some time researching. I think their fiscal fitness and quality is good. So, take a closer look. And, if you haven't already subscribed to FastGraphs, what are you waiting for? What a powerful, great tool, and how it makes it so much easier to evaluate whether the stocks are good buy, sells, or holds. Anyway, thanks for watching.